A stock breaks above a known resistance level. Retail traders see the upward momentum, assume a breakout is confirmed, and execute buy orders. Immediately, the price violently collapses downward, wiping out their positions. This failure happens because traditional geometric chart patterns, like Elliott wave theory, rely on subjective visual interpretations of price lines rather than measuring the raw order flow driving the market. Decades ago, reading the tape required human intuition and guesswork to estimate where trading volume was heading. Today, high-frequency algorithms are specifically coded to exploit those exact human vulnerabilities. This creates a ruthless mechanical paradox. Retail traders consistently buy breakouts at the exact price coordinates where institutional algorithms are aggressively selling to absorb their liquidity. To survive, you must understand the tape physics operating beneath the candlesticks. We're going to deconstruct the exact mechanics of what institutional operators call the nuclear junction. A nuclear junction is an algorithmic convergence. It is a highly specific price coordinate where multiple independent mathematical models are forced to execute at the exact same millisecond. Identifying these zones means abandoning subjective chart art. You have to measure the objective, variance-based physics that dictate exactly where large funds deploy their capital. This animated diagram tracks a 5-minute price chart, but it overlays 4 distinct moving average curves. These lines represent the heavier layers of institutional gravity operating on 15-minute, 30-minute, hourly, and daily intervals. The 2 fastest curves track the short-term momentum highways, mapping the precise routes used by ultra-fast attack algorithms. The 2 slower, heavier lines define the session's absolute baseline and the broader macroeconomic ocean tide. When all 4 curves fan smoothly outward in sequential order by speed, you have a pristine stack. This alignment proves that every algorithmic participant, from the high-frequency scalpers to the massive daily macro funds, is buying simultaneously. The result is aggressive, uninterrupted velocity expansion. But when those curves cross over each other, twist into a tangled knot, and flatten horizontally, the market enters the mixed blender state. Inside this blender, short-term attack algorithms are actively pushing the price down, while macro-institutional desks are simultaneously sitting at their heavier levels, buying the floor. This temporal conflict locks the asset into an inventory compression cage. The market has 0 net directional vector, generating violent oscillations between opposing algorithms. Attempting to execute a momentum strategy inside this desynchronized state guarantees mathematical ruin. You are simply providing liquidity to the chop. Momentum is only half the equation. You also have to map the structural price boundaries, and algorithms do not respect static, hand-drawn resistance lines. This diagram illustrates the 20, 40, 50 session block, rendering the price action like an airport runway. It completely replaces the backward-looking retail habit of drawing a simple box around the first hour's wicks. The runway centerline is the 50. This is the exact zone where a developing trend is either heavily defended or structurally defeated. Far past the core runway sit the H2 and L2 terminals, marking the absolute maximum standard deviation boundaries of the session airspace. When price strikes one of these outer terminals, it has reached a 95% statistical exhaustion point. The trend is out of fuel, priming the asset for a violent reversion to the mean. Mapping these structural cages allows you to automate a pre-engineered risk calculation before you ever place a trade. The engine takes exactly 40% of the live session range, dynamically updating that mathematical metric tick by tick as the market breathes. During a highly volatile session, this risk unit naturally widens. The math forces you to scale down your contract size to safely accommodate the wider structural swings. Dynamic variance mapping replaces emotional, reactive position sizing with a rigid system of capital preservation. Price structure maps the boundaries, but volume distribution provides the actual fuel to move between them. This lower third dashboard tracks order flow as it moves through a strict chronological cycle: impulse, consolidation, and exhaustion. The cycle starts with the A wave. This represents the aggressive market order impulse that initiates directional intent. Next is the B wave consolidation phase. The market compresses, and retail traders begin placing their stop losses just outside the established range. This triggers a deep liquidity sweep. High-frequency algorithms intentionally drive the price slightly below a moving average floor to hit those resting stops. Institutions absorb that sudden flood of panic selling, using the retail liquidity to fill their own massive buy blocks at a steep discount. You can track this trap in real time using the cumulative volume delta metric to spot institutional absorption divergence. The visual anomaly is distinct. The main price chart prints a new lower low, but the underlying CVD line simultaneously prints a higher low. This divergence proves that massive iceberg limit orders are actively absorbing the selling pressure. The algorithms are masking their accumulation behind a fake breakdown. What looks like a perfectly failing trend to a retail trader is actually a mathematically engineered illusion designed to source institutional fuel. Treating individual indicators or isolated momentum arrows as standalone trading strategies is highly dangerous. This hero chart illustrates the contrast. If an execution signal prints in open air, completely decoupled from structural backing, it is low-probability algorithmic noise. But notice the intersection here. Price drops perfectly into a coordinate where a 1-hour 50 EMA, a 40% concrete wall, and a bullish CVD divergence all collide. This is the nuclear junction. Because these metrics overlap, trend-following algorithms, cash settlement models, and order flow momentum models are all forced to execute simultaneously, compounding the buying pressure. Trading a junction allows you to execute with absolute operational certainty regarding risk. It enforces the rule of unconditional invalidation. If a candle prints a clean close below that 40% structural wall, the thesis is mathematically dead. Accepting this engineered invalidation removes all emotional hope from the trade. You take an immediate, calculated exit to protect your capital. Institutional trading edge has nothing to do with predicting price patterns. It is the rigid discipline of locking down your execution, firing only at the exact mathematical coordinates where multiple algorithmic timelines are forced to overlap.